Have you ever thought about what it really takes to steer something huge, like a massive railway, through really choppy waters? Not just ships, but, operations on land?
Hmm.
Well, that's exactly what we're digging into today. We're looking at Canadian National Railway CN and their latest Q2 2025 results.
Yeah, we've got the earnings call transcript, the press release, and basically our job is to sift through all the corporate speak.
Exactly. Pull out the key stuff, the surprises, and figure out what it actually means for you, the listener, trying to stay informed.
Especially, how a major railway like this is dealing with a world where trade, the economy, everything seems to be shifting so fast.
Okay, so let's jump right into the numbers. The Q2 2025 financials.
Right.
First glance, adjusted earnings per share, EPS, it was up 2%. Seems okay, right? Solid.
It does, but here's where it gets interesting. Because their actual revenue, it dipped slightly, down 1% compared to last year, came in around $4.27 billion.
Okay, so revenue down a bit. And what about the actual freight? Carloads.
Carloads were flat. And revenue ton miles, RTMs, basically how much stuff they moved times how far those were down 1% too.
Huh. So volumes flat or down, revenue slightly down, but profits up. How does that work?
Well, that's the story, isn't it? Yeah. It really signals this shift. They're making money now, not just by moving more stuff, but by being incredibly efficient and really controlling their costs very tightly.
And the context makes it even more, well, notable. Tracy Robinson, the CEO, she pointed out Q2 last year was unusually strong.
That's right. There was that potential labor disruption looming, so everyone was shipping early. It made for a really tough comparison this year.
So for them to actually improve their adjusted operating ratio, that key efficiency number, remember, lower is better, getting it down half a point to 61.7%.
While volumes weren't exactly booming.
It really makes you ask, okay, how'd they tighten the belt so effectively?
It shows a very deliberate focus, doesn't it? Yeah. They're managing the things they can control with real precision, even when the wider market is, unpredictable.
Okay, so let's get beyond the headline numbers. What was actually on those trains? What was moving?
The big win for them, clearly, was bulk. They said bulk volumes were very strong. Think grain, fertilizers. That whole segment saw revenues jump 12%.
Wow, 12%, that's significant.
Well, yeah. Canadian grain up 6%, U.S. grain up almost 30%. That was driven by corn exports, some new ethanol plants coming online, and the Iowa Northern Railway they bought.
Ah, the acquisition effect there, too.
Right. And potash RTMs were also way up, almost 30%, thanks to strong exports heading out through the Port of St. John.
So what's the takeaway there? Is it just good luck with the harvest?
Well, partly, maybe, but it really highlights how CN's network is set up. It's got this great access into farming regions, connects to key ports. It gives them a real structural advantage in agriculture. So even when other areas are weak, they can still capture that ag strength. It's baked into their system.
They actually set an all-time record for shipping grain and processed grain out of Western Canada for this crop year. That's genuinely impressive.
It really is. But of course, it wasn't all smooth sailing. There were definitely headwinds.
Right, the other side of the coin. They mentioned this shift in traffic mix. Less merchandise, less intermodal.
Yeah, and that dragged down overall revenue and margins a bit. Even though, interestingly, they managed to keep their pricing power, same-store prices stayed ahead of inflation.
Which is strong in itself. But what caused that shift? What were the headwinds?
A big one, and you hear this a lot lately, is the uncertainty around tariffs and trade, especially hitting Canada.
Okay.
Forest products, metals, autos, they're all feeling it. Remember those U.S. tariffs on Canadian steel and aluminum? They jumped to 50% in June. That directly hits shipments.
50%?
Yeah. And Janet Drysdale, who's the interim commercial head, she said these sort of on-again, off-again tariffs are forcing customers to rethink their supply chain.
I bet. That creates huge uncertainty for businesses trying to plan.
Absolutely. And it wasn't just tariffs creating problems.
Yeah.
Petroleum and chemicals took a hit.
Okay.
Apparently, about half the refineries in Western Canada had these unusually long maintenance shutdowns.
Yeah.
Unprecedented turnarounds, they call it. So fewer refined products moving.
Okay, refinery issues. Anything else?
Yeah, sand volumes were down too. Partly because of a fire damaging a bridge on a branch line, and also just less drilling activity needing that frac sand.
So, multiple hits there. And forest products, you mentioned them earlier.
Still facing risks. Higher softwood duties coming in August. There's still that threat of a U.S. Section 232 investigation hanging over them. Plus, the housing market recovery is, well, slow.
Right, and intermodal. Containers and stuff.
Also saw some weakness, particularly through the Port of Vancouver. Although, interestingly, Prince Rupert, their other main West Coast port, saw volumes rise 14%. They picked up some new business there.
Okay, so a real mixed bag on the volume side. Which brings us to the operational question. With all these different pressures, how do you keep a massive network like CN running reliably?
That's really the crux of it, isn't it?
Hmm.
And the message from CN is that despite all that,
Mm-hmm.
that turbulence in volumes and mix, the network itself is running very well.
Okay, very well. What does that mean in practical terms?
We'll look at their metrics. Car velocity, how fast the cars are moving, 213 miles per day. That's up 3% from last year.
Mm-hmm.
Through dwell, how long cars sit waiting in yards, that improved by 1%. And they hit their customer service commitment 95% of the time. So the trains are moving efficiently.
And that didn't just happen by accident, I assume?
Definitely not. They talked about how the team proactively and progressively adjusted the operating plan and resources. They were making changes on the fly as demand shifted.
Like what kind of adjustments?
Well, for example, merchandise workload dropped 7%, so they cut the number of mainline manifest trains, those are the mixed freight trains, by 8%. Very closely matched.
That sounds like really tight management, almost surgical.
It does. And they made big moves on people and equipment, too. They furloughed 560 train and engine crew members. That brought the total on furlough to 740.
Wow. And equipment.
Assets, too. They put 8,000 rail cars into storage. That's double the number from Q1.
Yeah.
And they parked 200 high-horsepower locomotives out 12% of the main fleet.
So basically idling resources they didn't immediately need.
Exactly. As they put it, these moves shield us from unnecessary expenses. It's about flexing down quickly.
But can they flex back up just as quickly if things rebound? That's always the question with furloughs and stored equipment.
That's a great point. And Derek Taylor, the operations chief, he addressed that. He said furloughed crews only need a few weeks of refresher training to come back.
Yeah.
Compare that to hiring someone new, which takes like 9 months.
Okay, so there's built-in agility there. Faster to bring back experienced people than start from scratch.
Precisely. It's a key part of how they manage costs, but stay ready.
And did this translate into better productivity numbers?
It sure did. T&E labor productivity train crews up 11% year over year. That's huge.
11%.
Yeah. Locomotive availability hit 92.5%, fewer breakdowns, which meant locomotive unit costs dropped 8%.
Okay.
Even in engineering, track maintenance and stuff, they had their lowest overtime in a decade. Tire replacement gangs were 7% more productive, and their unit costs were down 5%.
So efficiency gains across the board, really.
Seems like it. And one other point they highlighted was safety. Their injury ratio improved 16%. They said that was down to being more proactive out in the field.
Good to hear. So it ties back to what Tracy Robinson said,
Yeah.
right? Controlling the controllable.
Exactly. You can't control tariffs or global demand swings, but you can control how efficiently you run your trains, manage your crews, maintain your track. And they seem intensely focused, as she said, on doing just that to protect their margins.
Okay, so they've shown they can adapt and control costs really well. But looking ahead, what does all this mean for the rest of 2025?
Well, they're definitely dialing back expectations. They've lowered their volume outlook for the second half of the year. Now they're only expecting low single-digit RTM growth for the full year.
Down from low to mid-single digits before.
Oh, okay.
And, that flows through to the bottom line. Their forecast for adjusted EPS growth, it's now in the mid to high single-digit range.
Which is quite a drop from the 10 to 15% they were guiding to earlier.
It is. And maybe even more significantly, they've pulled their multi-year financial outlook for 2024 through 2026 entirely.
Wow, okay.
They cited the continued high level of macroeconomic uncertainty and volatility related to evolving trade and tariff policies. Basically, things are just too unpredictable right now to give longer-term guidance.
That's a pretty loud signal about the current environment, isn't it? Caution seems to be the word.
Prudence, caution.
Yeah.
Yeah, it acknowledges the fog they're navigating.
But they're not just sitting back and waiting, are they? What are the strategic moves they're making? No, they're definitely active. They talked about working with customers to lean into their strengths, that diversified business mix, especially the strong bulk and energy side.
Okay.
And where tariffs are hitting, like with metals, they're actively working with those customers to find other markets. Remember, we mentioned those intra-Canada and intra-U.S. moves?
Right, finding alternative routes when the main one gets blocked.
Exactly. And they're also really pushing their service performance as a way to win more business, especially in domestic intermodal, trying to leverage that reliability.
Makes sense. Play to your strengths. And Tracy Robinson kept emphasizing the network itself as a core advantage.
Yeah, that tri-coastal access, Atlantic, Pacific, Gulf Coast, serving those resource-rich areas up north. And that unique route that bypasses the Chicago congestion, that's a big selling
A
point.
huge bottleneck for other railways, yeah.
And the fact that they originate so much of their own traffic, over 85%,
Yeah.
and handle both the start and end for over 65% of their business, more than any other big railway.
What does that actually give them?
Control. More control over the service from start to finish. Fewer handoffs, potentially smoother journeys.
Gotcha. And what about those longer-term growth plans they laid out at their investor day last year? Are those shelved now with the reduced outlook?
That was interesting. They said those CN-specific initiatives are still intact.
Mhm.
They see the current situation as just a timing issue until the tariff stuff gets sorted out.
So the underlying growth projects are still planned.
Seems so. Things based on their network advantages, like boosting intermodal through multiple ports, developing energy transport from northern Canada, frac sand, canola processing, integrating Iowa Northern, that's all still on the agenda, just maybe delayed a bit by the current headwinds.
Okay, that's important context. Now, you mentioned earlier that quote about tariffs forcing customers to rethink supply chains. Let's unpack that a bit more.
Right. It's a really significant point. In the short term, we're seeing those immediate reactions, like finding new, maybe less direct routes for metals within North America.
Tactical adjustments.
Exactly. But the longer-term implication is potentially much bigger. Janet Drysdale mentioned customers are now seriously exploring ways to reduce their dependence on the U.S. market altogether. Maybe source more offshore or find non-U.S. destinations.
So this could actually reshape trade flows more fundamentally over time.
It certainly could. It reflects this broader strategic reassessment happening across many industries. And speaking of shifts, she also noted something interesting about intermodal shipping patterns.
Oh, yeah.
That whole idea of a big fall peak season for container imports. She said it's become a pretty elusive concept since the post-COVID disruptions.
Huh. So the traditional rush before the holidays isn't happening the same way.
Apparently not. She mentioned maybe some inventory front-end loading happened earlier, possibly making July the peak this year. But overall, consumer sentiment is still a big question mark, making demand really hard to predict.
Yeah, the unpredictable consumer. Always a factor. Okay, and what about CN's own spending? You mentioned cost control. Does that extend to their big capital projects?
It does. They said they're watching CapEx pretty closely. They've already trimmed their budget for this year by $50 million, down from the initial $3.4 billion plan.
So, tightening the belt on investments, too.
Seems like it. They're focusing on capital efficiency, only investing in growth where they have clear line of sight and certainty. Mostly, that means projects in the Western Corridor supporting energy exports and other specific confirmed growth areas.
Makes sense in an uncertain climate. Don't build it if you're not sure they will come.
Pretty much.
Yeah.
And one last thing that always seems to come up in rail discussions. Mergers. There's been chatter again about potential big mergers in the U.S.
Right, the transcontinental dream for some. What's CN's take on that?
Their official stance is, they won't speculate, but they did reiterate their view that you can often get similar benefits through commercial partnerships and agreements without going through the massive disruption and complexity of a full-blown merger.
Plus, the regulatory hurdles are pretty massive these days, aren't they?
Exactly. They called the barriers high and untested. They also made it clear that if any merger did happen involving others, CN would expect its competitive options to be protected or even enhanced.
They'd fight to maintain their access.
Oh, yeah. They said they'd rigorously defend our competitive access. And they feel their own strengths, like originating so much traffic. And that Rupert advantage sending Midwest volume down their lines would remain strong regardless.
And they pointed to things like their Falcon Premium service, right?
Yeah.
Mexico to Canada.
Yeah, as an example of focusing on north-south growth through those kinds of commercial deals, not necessarily mergers.
Okay, so let's try and wrap this up. If you had to summarize CN's Q2 and their current position...
I'd say it's a story of resilience and really impressive agility in a very tough, uncertain environment. They're pulling the levers. They can control costs, operations exceptionally well.
Right. Adapting quickly to shifting markets, shifting trade winds.
Exactly. They've shown they can manage costs effectively and keep the network fluid, even when the mix of traffic changes unexpectedly due to things like tariffs or refinery problems.
And they're banking on their unique network and those longer-term growth plans to see them through once the current fog lifts.
Yeah, they believe those strategic advantages position them well for whatever the evolving trade landscape throws at them next. It really demonstrates how operational discipline can help you weather a pretty significant storm.
So that leaves us with a final thought for you, our listener, to chew on.
Hmm.
In this era where global trade rules seem to change almost overnight, what kind of unexpected new trade routes or maybe completely new supply chain designs could emerge as companies like CN have to constantly adapt just to protect and maybe even grow their business?
That's a fascinating question. What new pathways might be forged out of this uncertainty? Something to think about.